Hello, everyone. I think we're live. Thank you all for joining. Um, this is exciting. This is our first episode of the Road to Onward FX series, which is a short virtual series for founders that are raising in 2026. We designed this series with you in mind, the founders. It's meant to help you show up to your fundraisers this year with less vibes and more clarity. And I couldn't think of two more uh, influential, sharp minds than to guide us through that journey today. So welcome to the Road to Onward FX. And for those of you that don't know, Onward FX is our in-person event that we host twice a year. The next one is coming up on April 21st here in Bentonville, Arkansas, where I'm sitting right now. We will bring in 30 to 40 investors, tier one firms from all over the country, and we set up meetings with vetted founders. The whole goal is to compress the time from first meeting to term sheet, which means that our team is doing a lot of that back end, double opt-in, writing memos in every company, helping you founders get leg up in those kinds of conversations. So historically, 25% of startups that have participated in this event have walked away with term sheets in the 2 weeks following the event. So if you're raising this year, here's my call to action. It's one of the best, most concentrated ways to get momentum. And our application deadline for that, and I'll pull it up in just a second, is February 23rd. So let me just pull it up. If any of you want an easy reference, give me 1 second to do that. Oh, sorry. I will pull it up at the very end for anyone that wants to scan the QR code, and that'll take you straight to the application. Um, and the other thing to note, which I will pull up at the end as well, is that this is one of 4 sessions that's coming up this month. Every week in the month of February, we'll be hosting sessions with, again, the best minds that we know, that are all meant to kind of pull back the curtain on what it means to be venture scale, what investors are thinking about in the first 10 minutes of your meetings with them, and what it means to be in due diligence and what that process looks like from the investor perspective. And today's session, which we're so excited about, is called What the Data Actually Says About Today's Early Stage Market. Operative word in there being actually. So what we're doing today is taking a step back. We're looking at what thousands of actual startup financings are telling us about what's really happening in the early stage market today, what founders are raising, what terms they're signing, what dilution they're taking, and how that's shifted from a few years ago to now. I mean, even in the last 6 months. We're joined by Peter Walker, who leads insights at Carta. He's built this data set and is sharing this hot off the press data with us, and Monique Woodard, who's the founding partner at Cake Ventures. Monique will help us interpret what this actually means from a decision-making perspective. So without further ado, let's get into it. Peter, why don't you start by walking us through what you're seeing firsthand?
Absolutely. Thanks, everyone. Appreciate you all joining us. So, as mentioned, we're going to waltz through a bunch of data here and then get to sort of have Monique's unique perspective on what it means, sort of slide by slide. Couple points. If you have questions, throw them into the chat. We'll monitor them. We'll also have some time at the end for Q&A. But the whole goal is to be responsive to the things that are most interesting for you all as you're going out to fundraise this year. This is from our lawyers. They make us start this way every time. I can't get rid of it. And yes, you can have this deck. In fact, don't email me. We'll send it out to participants afterwards. So no need to screenshot unless you just want to make us feel good. Up front, I've started adding this caveat to every time I present any data. This data is a result of thousands and thousands of financings, and by definition is a generalized picture of reality, meaning some of this does not apply to you. I think it's probably one of the hardest parts about being a founder is not getting advice, but choosing whose advice to follow. So there is no way that every single part of this presentation is going to be useful to you or applicative to your situation. You should be selectively ignoring at least some of this advice. Yes, even if it comes from Monique or myself, because it just isn't as specific as it needs to be. And I'm sure we'll highlight this again and again as we go through things. Okay, all of you are thinking about fundraising. So I thought it would be useful to start by describing the kinds of fundraising methods and pathways that we're seeing most commonly out in the market today. So, of course, the standard venture capital path of raising a seed round and then a Series A and a Series B and on through the full VC stack, that is for some reason considered the default way to grow these companies. Of course, it's not truly. Bootstrapping and funding companies through revenue has always been a much bigger slice of all of startups than venture is. But there's also a couple of different models that have come in lately. The first one is seed strapping, which means you raise a little bit of capital, call it 1 million to 3 million, something like that. And then you try to get as far as possible without any other external funding. That is a pathway that we have seen founders attempt to take more often in the last couple of years. And then we can talk about whether or not it's working. And then the last one is a late VC, meaning you start as a bootstrapped company, and at some point you get big enough and attractive enough to VCs that they are excited about investing into you, even though you're already a pretty scaled concern. This is Atlassian, some, at the end of its life before IPO took some funding, et cetera. So that's also a path. Monique, I wondered, do you see a lot of founders trying that seed strapped model these days?
I see more of them trying it. I actually have one of these in my portfolio right now where, they raised a seed round and, now they're doing mid double digit millions in revenue and they're not thinking about raising an equity round for the foreseeable future. And so it's definitely happening. I think and we'll talk, AI will continue to come up. With I hear more founders saying that they can get further with less money, and therefore, they are more interested in this seed strapping strategy. But at the same time, you certainly see and hear um, other founders in AI and outside of AI saying that even though we could seed strap, we're going the full VC route.
Yeah.
So it really depends on access to capital, how you feel about venture, and what kind of company you want to build.
Yeah. The point about what kind of company you want to build is such a good one. Some of this comes down to personal ambition or your
Yeah.
goals for this company. The other thing that I don't know if you feel this way, when I talk to some seed stage investors, they are a bit skeptical of seed strapping as a model. Some of that may be for good reasons. I get the sense that some of that is also because it's much more difficult to explain to LPs what
Yeah.
that company is doing if they're not going to show progress along the way with a Series A, a Series B, et cetera. So
Yeah.
maybe it's a little bit of talking their own book a little.
Yeah, it's totally talking their own book. I think any skepticism about the seed strap model is more along the lines of, I don't know how to explain this to auditors. I
Yeah.
don't know how to value this 3 years out. I don't know how to talk to my LPs when I go out for my next fund about the performance of this company. And it's not a straight up, they raised a Series A, we marked it up,
Yeah.
right? There's more nuance there. We have to dig into the numbers. We have to do a third party valuation, which is what I have done in my portfolio. And so I think when you hear investors say that, please take it with a grain of salt that we're talking our book and trying to make things easier for us in some ways,
Yeah.
and not it's not entirely about the seed strapping model itself.
Yeah. There's altruism amongst investors, but I wouldn't say that it's the only thing that they're worried about when they're talking to
And
startups.
and I do straight up ask people, um, what kind of company they want to build, how they
Yeah.
want to build this company, what it looks like in 7 years. Like I'm asking those questions to get to, does your model of company building fit my model of firm building?
Yeah. Yeah.
Because those two things do have to align in some way.
Yeah, there's a graveyard of companies for whom they were probably great businesses, but the capital model didn't match the
Yeah.
ambition. And that can be really, really difficult 3, 4 years down the line. Um,
Hmm.
all right. So all of you that are in the fundraising process, if you've decided to fundraise, you're probably going to start on safes or notes. And to be honest, almost all of you are going to start on safes. The simple agreement for future equity,
Yeah.
popularized by Y Combinator. It's a very simple contract that says, I'm an investor. I give you money today. You give me equity in the future whenever you raise a price round based on some terms that define the conversion. So, number one, everybody's using safes. Safes are the dominant way of getting early capital into young startups. 92% of all the money that we saw before priced rounds went on safes, not notes. The only real difference between these things is the safe doesn't have an interest rate and the note does. So the note is technically debt, whereas the safe is not. Um, I don't think you'll run into too many notes if you're building a software company. If you're building hard tech or bio, maybe sometimes. But Monique, I don't know if you see any notes out there. We're basically only seeing safes.
I so rarely see notes. I think I've only signed one note in the last like 5 years,
Yeah.
right? And so, and it was in a category that you mentioned. It was a not exactly a straight up software company.
Yeah. And so Neil asked a good question if we're seeing any resistance to safes. No, not at all. Some of that is a little bit behind closed doors. You do hear investors say, I don't know if I love the safe for specific reasons, particularly QSBS or tax or things
Yeah,
like that. I honestly, I just like this is the water that we're all swimming in. It's
yeah.
there will be a thing after the safe. I'm convinced of it. You just as a founder don't need to worry about that. Let investors or lawyers like figure out what the right instrument is there. Like safes are just you should learn it, you should know it. Most every investor I talk to is okay with a safe.
And I think, the only time you might see some resistance from investors is if we feel that you've stacked too many safes,
Correct.
right?
Yes.
And and I think we're going to talk about that in a little bit, but
Yeah.
that's the only, if you are just starting out and you're raising on a safe, that is totally normal. No one, no institutional investor in particular or sophisticated angel is going to push back on that.
100%. Yeah. You can, yeah, just because safes are well used doesn't mean they can't be misused, and they often are. Um, okay, so what kinds of safes? There are a couple different points here. First is post-money safes, the orange bar on the left, dominate the conversation. Pre-money is less and less. Post-money simply means that the safe gives clarity up front about how much ownership is actually going to change hands. So if you raise $1 million on a 10 million cap safe, you've sold about 10% of your company. Might be a little bit different given the option pools and whatever, but you have some sense of how much equity you're actually selling, and the investor has some sense of how much equity they've bought, which is important if you're doing early stage deals. The second thing is that there are two terms that matter with a safe: a valuation cap and a discount. You can use both, you can use neither, etc. The current pattern is that the majority of safes are just valuation cap only post money safes. There are some with discounts. There are some with discounts only. If you get someone to give you a safe without a discount or a cap, I think those are your parents. Like those don't really exist in the real world. But um,
Yeah.
by and large, valuation cap is the term that is most negotiated with investors. Which brings us to what should your valuation cap be? This is where it starts getting emotional. So again, if you're raising $1 million in that 500K to 999K band there on the row, you see that the median valuation cap for that raise is $10 million. So that means you raised a million on a 10 million cap, meaning you sold 10% of your business. But as you
Mhm.
can see, these bars are super wide. You can do it on a 6 million cap, you can do it on a 20 million cap. And I'm here to tell you that no matter how much you want this process to be meritocratic and easy to understand,
Yeah.
there is no perfect numbers here. A lot of how you're going to raise is going to come down to who you are as a founder and what sense of demand you have from the market. So I don't know, Monique,
Mhm.
when you're walking founders through these valuation caps, like how do you explain what they should be or should not be expecting?
Um, Yeah, so one, every fundraise is different.
Yeah.
And there are a lot of, there are a number of factors that determine where you're going to fall within these bands. Um, Geography, type of investors that you're talking to, location of those investors, your background as a founder, your category that you're building in. All of those things matter and really inflect like where you are within these bands. Um, the thing that I will say for this room is that no fundraise, all fundraisers are not the same. There are so many different ways to raise your seed round, your A round, your pre-seed. And so we're going to give some generalized advice, but there's more than one way to do this. I sometimes founders will say, well, I priced it low so that I could get it done quickly. That doesn't always work.
Yep.
um, that actually kind of some often does the opposite, have the opposite reaction. Um, or they will say, well, I saw so and so raise at this cap. And so now that's where I've pegged my cap.
Yep.
And that too, for all of those reasons that I just said, is also not a great way to like figure out where you land within this band.
Yeah.
So it really takes a lot of like nuance and soul searching and like
Yeah, a little bit of
and
therapy,
and a
a little
little
bit
bit
of
of come to
finance.
whatever deity you believe in,
Exactly, exactly. Um, and not only that, of course, when you're raising on a safe, because you don't need to just get all the potential investors in a room and hash out all the terms, you can just
Yeah,
raise one safe check and then another safe check and another safe check, and you can have different terms on all of them. So it gets pretty confusing pretty quickly. We do see some founders do this thing where they're trying to tranche the round, meaning I'm going to raise a little bit of money at this cap, and then the cap is going to go up, and I'm going to go back to investors and be like, cap went up, better get in now. Um,
yeah,
that is a I've seen it work. I've also seen it completely flame out and really
yeah,
wreck your reputation because if you tell investors you can get in at an 8 million cap this week, but next week it's a 10 million cap, and then you come back to them and say, "Oh, kidding, there's a special 8 million cap one-off offer. It's still live this week." You've just wrecked your credibility, and
yeah.
you misunderstood how in demand you were. So I would up front, I don't think this is an amazing strategy. I think it burns more people than it helps.
I generally don't think it's a great strategy. I don't love it as an investor.
Yeah.
I have seen it work well, especially at pre-seed.
Yep.
And I'll explain the nuances of that. So if you say, I'm going to take the first 250K from angel investors and friends and family and sort of, these non-institutional checks, small checks that kind of add up to a 250, and I'm going to take it at a $7 million cap, for instance. And then you say, okay, now that money is done. I'm going to take the next money and focus on institutional investors. And I'm going to take, you know, um, checks that range from 250 and up. And I'm going to take that at a $10 million cap. I
Yep.
think that is reasonable. I think, having some like weird cap in between that tries to deliver FOMO,
Yep.
I think that's where you end up getting into trouble and where investors like really don't like it. And then they see it and they're like, no, 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 I'm backing off.
Couldn't agree more. The difference is there. It's like you treated them as different rounds as opposed to little tiny slices within a round. I
Hmm.
think that's probably better. You know, the flip side, everyone focuses on valuation cap, but oftentimes when I'm talking to founders, I try to encourage them to think about this in terms of dilution. It's the exact same math equation. You're just focused on the actual how much are you selling part versus the valuation
Hmm.
cap. There's no perfect way to do this. There's no morally right way or amount of money, amount of equity that you should sell, but you can get out over your skis. You know, there are founders who sell 20% of their
Yeah.
company, 25% in their pre-seed, and they realize that was too much. You know, that wasn't worth what the money that I got from it. So it's not to say there's a perfect place to fall in these lines, but if you think about it a little bit more from the dilution aspect, aside from, oh, I have a $10 million valuation cap, therefore my business is worth $10 million. That's not really what it means in this stage.
Yeah. And
Um,
I would say that I often see founders give up too much of their money, give up too much of their company up front, when they have raised early rounds from like less sophisticated investors, angel investors who don't understand the later capital needs and the ways that those investors are going to view the cap table and the ownership. And so then, the later investors, let's call them the seed and series A investors, are going to say, do I want to recapitalize this company, or do I want to just move on and find a cap table that's cleaner?
Yeah, there are deals that get passed on even if the seed investor is excited about the business because the cap table doesn't work for them. That does
Yeah.
happen. So it is something to be aware of. Question in the Q&A about what gets put into valuation caps. The questions like, do grants and patents and famous investors, et cetera, boost the valuation cap, or is it just a revenue thing? Um, I mean, I'll let you answer this, but the answer is yes. Everything goes into the cap. It's
Yeah.
basically like it's an expression of what the demand is for your company, effectively.
Yeah. Yeah. All of those things, lead to increased demand. Um, Sometimes there are some of those things that people will care less or more about.
Yep,
But they all kind of speak to, I would take it as like a holistic view of your company and your position in the market as a founder, and they all matter.
100%. The other thing to note is we have these really big accelerators in startup ecosystem world in the US these days. I'm thinking particularly of Y Combinator, but there are some other ones. A16Z runs Speedrun. There's some other really big accelerators, and there's actually a ton of little incubators and accelerators out there as well.
Yeah.
Their deals, if you really read through all of their deals do, in a way, set some sort of market, at least for Silicon Valley founders, where they kind of get the sense, okay, why if I joined YC, they would take this much. And by the way, that this much is about 7% of your company for their initial safe, plus a free rider safe that kind of goes up and down based on how much you raise. When you net it all out, a YC company typically gives or sells YC about 8 to 9% of their equity. So, as that is the benchmark, if I joined YC, I'd sell 8% to YC. That's that does play into some people's minds around how much money am I getting versus how much help am I getting. Obviously, there can be angel investors or pre-seed investors that are more impactful for your business than YC. And YC is not great for every company, but they play this role of kind of like setting the market occasionally.
And I would say they also play a role in setting the market for um, valuations at that point in time in the Bay Area, right?
Yes.
And so, if YC demo day comes around and everybody's raising at 25 or 30, then all of a sudden that's the new number, at
Yep.
least for companies that are in the Bay Area and look similarly and can command that same kind of demand. And
100%.
so that's another way that YC kind of moves or influences the market.
No doubt.
And I think the question is like, should that move or influence the market for everyone? I would say probably not.
No. Definitely not. It's like, look, we can probably say this 100 times. Like the market for startups is not the market for your startup. And
Yeah.
those things can be very, very different. So as the data nerd, for startups, I spend a ton of time in this data, and yet it isn't always the most impactful thing. You don't need to be raising at the median, et cetera, et cetera, et cetera.
Hmm.
One note, if you're raising on a safe, obviously we said that valuation cap only is the most common. If your safe does have a discount, for some reason, the discount is basically never negotiated. It's usually just 20%. I have some thoughts about why that is, but we can kind of move on here. The valuation cap, you'll kind of go back and forth on. The discount is you'll take 20%, and that's just kind of what it is.
Yeah.
Yep. Last note. Uh, when you signed a safe, it used to be very simple. It was a 5 or 6 page document. It had a couple of clauses, really easy. Nowadays, most VC funds, not necessarily angels, but institutional funds, will also attach a side letter to the safe. That side letter has specific rights that they would like in the deal. So these are the three most common. Most favored nation, MFN, which is, hey, if you give anybody else a better deal than this, I also get that deal as the investor. Information rights, which boils down to like, please talk to me once a quarter. This is totally fair. You should always, be open with your investors. And then the last one, which is the important one, which is pro rata. Um, that gives the ability for the investor to continue investing into your business as you raise more money to maintain their ownership. They don't have to, but they have sort of the right to
Mhm.
moving forward. I don't know, Monique, I don't know if you run into any problems with pro rata or if you have thoughts on how founders should think about pro rata specifically.
I think it makes sense to, honor side letters from institutional investors.
Yeah.
But for instance, when you've raised from angels, um, you know, MFN and information rights kind of just end up getting a little bit messier than necessary for like a 50K check, right? And so I would say only sign side letters for institutional investors, micro funds, like formalized funds,
Yeah.
and more uh, institutional family offices
Yeah.
if you have those.
100%. You don't need to uh, give pro rata to everyone and like be careful about
Yeah.
the things that you're signing. Even if you can get over those conversations later, they just introduce annoying conversations for you moving on. Um, all right, so that's safes. Lexi, you put a question in the chat about saying that safes indicate to investors that you are unsure of your company's worth. I could not disagree more.
Mm.
Safes are that is not what safes mean. So unfortunately, I think your fellow founder friend was wrong on that one. All right, so let's talk about seed rounds. First off, these names, pre-seed, seed, Series A, they don't mean anything. They are just collective agreements about something that kind of looks like a shape of a round. You can put these names on any kind of round, right? Mira Murati 2 years ago raised a seed round of $2 billion. Would that
Yep.
be a seed round at any other age? Probably not. So don't get too hung up on the names. They kind of shift over time. They're not fixed. There's no standard Webster dictionary definition of what a seed round is. Um, the idea here is to illustrate for you all that seed as a market is pretty healthy in terms of the capital invested, but fewer companies are fundraising. So on the left side chart, you have total capital raised every year. It's going up in 2025. It's going to be pretty high. But on the right side, ignore that subhead. That's total rounds. And those have actually come down year over year. So more money into fewer companies, which is concentration, consolidation.
Mhm.
When I don't know if this like sparks any thoughts in you, but like to me, this suggests that it's not easy to raise a seed round, even if you look at the mega capital being raised by a couple of different founders.
Yeah, I think, there's always a lower graduation rate from pre-seed to seed. There are a lot of like pre-seed companies that are not going to make it into seed, but
Yeah,
I think we've seen even more lately. Um, I would ask you, does that signal that people are staying in pre-seed longer and possibly stacking safes that aren't getting captured um, in the data? Uh, and, from a larger, what does this all mean kind of point, I think having fewer successful seed rounds means less innovation, which is not great, in
it's
my
not
opinion.
great. We still capture the safes even if they haven't converted. There are a bunch, quite a lot of unconverted safes out there where, yeah, those companies are just never going to get past pre-seed. I think a
Yeah.
rough estimate you're looking at of the companies that raise a pre-seed, maybe half at the high end
Mhm.
raise a seed round. So it's definitely not an easy jump between these two things.
Yeah.
Um,
That's the expected attrition that I think every pre-seed and seed investor
yeah.
models, is that 50% of your pre-seed deals will not make it.
Yeah. And now we get back to the idea of this is a tale of two markets. So this is data for seed round valuations on Carta year over year. What the sort of call out boxes show is what is the gap between the median 50th percentile deal and the top 5% deal. Right now on Carta, like a top 5% deal on seed is an $80 million valuation, which is wildly high. Um, but I think the key point is the gap between those top 5% deals and the median, it just keeps growing. It keeps getting
Yeah.
wider. And so there really is this tendency to look at the deals that you read about in TechCrunch or on Twitter and assume that that is reality, and it almost never is.
Hmm.
So I think there was a question earlier about benchmarking yourself at outliers. I think benchmarking yourself against the highest deal in seed that you've read about is a really easy way to feel bad about yourself. And it's not good for you emotionally or financially, to
Yeah.
be honest.
Yeah.
Yeah.
And most of the deals that you are going to read about where evaluation is attached are those outliers. And so it makes it seem like or look like everyone is raising at these massive valuations when that couldn't actually be further from the truth.
Yes.
And so definitely avoid judging yourself and benchmarking yourself against, these top valuations, but also, you know, sometimes founders then have the tendency to shift where they think their valuation should be and walk into a meeting with an investor, um, completely misreading, what their valuation should actually be
Yeah.
and what they
It,
can command in the market.
yeah, it's just you want to give the investor when you're meeting them the idea, the confidence that you kind of understand where you are. Um, but if you walk into an investor meeting, you've been having trouble fundraising and you're looking for $100 million valuation for your seed stage startup, I mean, you better be unbelievable, right? You better be the best founder they've met in the last couple years. Um,
Yeah.
the cash raised here, but I think actually that introduces another question, Monique. I feel like founders sometimes look at this as the market and say, okay, I can situate myself in this market. But
Uh-huh.
really, what they should be thinking about is I'm meeting individual VCs. The goal is to be the best company or the top one of the top two or three companies that they meet this year. So I don't know if that like
Hmm.
how founders should think about investor deal flow or the other deals that they're seeing. I'm not sure if that's even useful for them to spend time thinking about.
Um, that is a factor in that, like, you're not really competing against the deals that are on TechCrunch. You're
Yeah,
competing against the deal I saw last week or 2 weeks ago or whatever. And so those are the comparisons that I'm making in my head. Like, is it worth my time for me to spend time on this deal
yeah,
versus the deal I saw 3 days ago?
yeah.
Um, but as a founder, you can't know the deal that I saw 3 days ago.
Correct.
And so, um, is it worth it to, to get angsty about that? No. You
Right.
just have to talk to investors who you feel like you have a high likelihood of they will like this deal, they will understand this deal, and this is an investor that I would like to have on my cap table. And
Super.
then when you go into it, being able to sell your company appropriately for them to get excited, and then to talk about valuation in a manner that is reasonable for that fund and for your business.
So many different factors there, but the one that I doubled
Yeah.
down on is you should know the person you're talking to before you get on the phone with them. You should have done your research on this investor, the
Yeah.
kinds of things they invest in. Hopefully, if they're a great investor and they publish this data, the kinds of checks that they write. All of that sets you up for success in a way that spray and praying a million emails cold outbound
Yeah.
is just not going to do for you on most days. Um, so, Scott, you asked a question about what's going on in Middle America. Here's an example of that data. Where you raise your seed round definitely matters. So, the median here is that light gray. In the Midwest, the median valuation for a seed round is 12 million. in the West, dominated by California, it's nearly double that. So where you raise your seed round definitely matters. I want to make a point broadly here. Raising the most highly valued seed round is not the same thing as succeeding. Um,
Hmm.
high valued seeds or really high valuations of any kind set you up to execute perfectly. It's great if you're going to make it, if every part of your business is going to go perfect from now on, or if you have truly outsized ambitions. But a really high valuation can be just as much of a hurdle as it is a help for very early companies. So it's not to say that deals in the Midwest are somehow worse all the time, but there is a clear difference between fundraising from Silicon Valley and fundraising in other parts of the country.
Yeah, and a lot of those companies who raise at a high valuation, even for the Bay Area, are going to have to grow into that valuation.
Yes.
And do they have enough capital to grow into the valuation so that by the next round they can justify a step up
Yep.
or justify a round at any price or not? And
Yeah.
so sometimes I think it's better to be more conservative on valuation, no matter where you are, so that you are not having to grow into a valuation, but you have the valuation that actually matches your company and the metrics that you will have for the next round.
Yeah, so if we just do some basic math here, if an investor expects, which this is data that we have, your company is going to grow in valuation between seed and Series A by 2 to 3x,
Mhm.
in the middle. So if you raise at a $10 million valuation for your seed, you need to be a $30 million company by the time you raise your Series A. But if you raise at a $20 million valuation, you have to be a $60 million company, and all of the metrics have to be bigger. So if you raise that same amount of money, the same size seed round at 10 or 20 million, you have to grow 2 to 3 times faster on the same amount of cash to make the math work for your Series A investor. Some founders do that, no doubt, or they raise a little bit more money, but it's not always the case that raising at the highest valuation is going to set yourself up for success.
Mhm.
Scott, yes, pre-seed to seed, a little bit wider ranges on what the step up is. I'll tell you this, if you raise on a safe as a pre-seed and then your seed round comes in exactly at that safe val cap, your pre-seed investor is not happy. That was not the goal. They wanted to get in early and
Yeah.
get a better price.
Yeah. Otherwise, I could have just waited and invested in the seed round.
Exactly. I lost time, right? The time
Yeah.
value of money there was like a zero for me. It was actually net negative because
Ex
I could have done something else with it.
exactly.
Okay, and so in this continuing theme of not all seed rounds are created equal, all of these bubbles represent industries, and every industry has its own little different dynamics. So on the x-axis here, that's how much money did you raise in a seed round? The median on Carter right now is like 3.5 million. And the y-axis is what was the valuation? Median valuation pre-money is about 16 million. So semiconductor companies up there in the upper right, pretty hot right now, getting big rounds at high valuations. Medical device companies on the lower left, low valuations and smaller rounds. But you can see these bubbles, aside from semiconductors, which is kind of their own thing, they kind of float along the same line, right? They're like a little above, a little below. But if you just drew that invisible line through the middle there, that is the dilution. That is how much equity you're selling. And it generally comes to about 20%. Not always, there's ups and downs and et cetera, but you should expect that you're going to sell around 20% of your company if you're building a software startup. And if you're building a hard tech startup, maybe a little bit more than that. So any
Mhm.
thoughts on like this general picture of seed?
Uh, no, I mean, I think it's very accurate. I find it really interesting that, the health tech is right there kind of in the bullseye.
Yeah,
Um, I spend a lot of time in that category, and I would say like this tracks from what I'm seeing.
right. Melody, CPG here would be, we would call it DTC retail. It would be kind of between renewables and food, not a hot sector at the moment,
Hmm.
I'll say. Um, one of these bubbles has AI companies within it. And so if you just take all those AI companies and make them their own bubble, it dominates the chart. Like AI is the dominant theme for venture investing these days. It is inescapable. I'll say this, if you are building a software company and you are explicitly not using AI, you better have a really good reason.
Yeah.
Because why are you not? Is the question.
And it's
I
going to
run
be
across
very difficult for you to find an investor who wants to spend any sort of time on that company.
100%. As mentioned, dilution around 19, 20, 21% for many sectors. If you're building a biotech company, it's usually a little higher. Most of that, by the way, is because A, building physical products in the real world requires more cash up front. And B, because of that, there are fewer investors interested. So smaller investor
Hmm.
pool plus more capital up front equals higher dilution for founders. And then we get to the time. So one of the biggest inputs to your whole model is how much time is it going to take me to go from seed to Series A? It used to be that, that orange zone was the advice that you'd get from a VC saying, I don't know, 18 to 24 months or so. That used to be very, very true. But you can see that the bars and the bubbles are getting a little higher lately. And there are companies that are taking 2.5, 3, or even 3.5 years to go from seed to A.
Hmm.
So you got to be pretty sure about how you're going to spend this money and how long it's going to take you to get there, because you don't want to be looking around going, I have 4 months of cash left in the bank for this company. That's a very difficult place to fundraise from.
Yeah. I have seen this, play out over the last couple of years where normally I would say you need to be looking toward Series A at 18 months, and
Yep.
now it's increased to 2 years, so 24 plus months. Um, but between that, I'm often seeing again the safes come into play.
Yep.
So you did a price seed, it's been 18 months. Maybe you do a safe note in between to
Yeah.
get you to that A. And so, you know, there is this like round in between the seed round and the series A, which I think is a little bit more prevalent today.
Yeah. With those like Series A seed bridges, seed
Hmm.
plus, seed extensions, Series A junior, whatever you want to call them.
Pre-A.
Yeah, pre-A, that's great. Seed two, um, the return of the seed. There's a lot of names. They get floated around. Um, I thought I had some data on it, but unfortunately not. So one note, this is a very like in-depth chart, but what it really is just telling you is how many companies go from seed to A and how long does it take them. So if you just look at that Q8, that means 2 years after your seed round, what percent of companies had raised a Series A? 40% after 2 years, which happened in 2020. That's a lot of companies. That's lots of companies
Yeah.
moving very quickly. It's more usually around 15 to 20% after 2 years. So you're not necessarily behind, but just know that like effectively half of these companies will wash out and not make it to Series A. And sometimes it takes 2.5 or 3 years, and having enough capital on hand to make it over a missed expectation is paramount. These plans
Yeah.
are just plans and they almost never go perfectly. So I understand the companies who want to raise as little cash as possible and keep dilution low. That's great, but you're assuming no mistakes, and that's very
Yeah.
hard.
Yeah, exactly. And I would say who is on your cap table matters. Do you have institutional investors who have enough dry powder to, fund you in that gap between the seed and the A?
Yeah,
And as an investor, I'm thinking, should my capital be best spent on a net new company
yeah,
versus, doing the seed plus or the extension?
yeah. It's a big
And
deal.
in a lot of cases, my math tells me that I would be better off investing that capital into a new seed company versus trying to do the extension that gets this company to an A.
I mean, founders for a second, imagine you're an investor. You invested in a company. There was a plan. That company comes back to you after 2 years and says, we missed the plan, but we think we're still a good bet. Could you give us more money? Depends on how you feel about those people, right? But like you don't do bridges for
Yeah.
companies that are crushing it and don't need a bridge. Um,
Yes.
bridges are always tricky. You should never assume that just because an investor gave you money, they are going to continue to give you money in the future.
Hmm.
You kind of re-earn that every time. Um, okay, Series A. I think this is another interesting view of it. The orange line is the median valuation. So you can see it peaked in early 2022, took a real decline in 23 and 24, and has kind of made its way back near to peak in 2025. But the bars tell the other story, which is the number of rounds. Peaked in 21, hasn't really climbed back up in 25. So yes, valuations are higher, but fewer companies are getting to raise. And so again, this is the story of concentration that kind of shows up again and again and again when we look through venture data.
And I would say another outlier thing that I'm seeing with companies that raise Series A, and again, this is an outlier, but companies that raise a seed and then very quickly raise a Series A
Yeah,
at a very high valuation.
yeah,
Uh, Typically, those are again companies that are straight up AI companies, infrastructure, foundational kind of
yeah,
companies, or companies where the founding team, is well known.
yeah.
Um, but I am seeing companies raise a good seed pretty quickly, and then, in 6, 9 months, raise a Series A.
Yeah. And it's important, even if you're not those companies, it's important to know about them because that's where a lot of investor capital is going.
Yeah.
Right? If an investor in your seed round leads your seed round, and then you raise a Series A 9 months later, well, the investor in your seed round is almost certainly going to want to participate in a company that's growing that quickly. So maybe they have to shell out a lot of cash to involve themselves in the A, and therefore they have less money to invest into new companies. It just kind of all feeds back into this cycle of more
Mhm.
capital concentrated into fewer companies. Um, so
Yeah.
this is probably the question that you were all wondering when you came here. How much money do I need? Right? What is the right ARR level for me to raise a Series A, a Series B, etc.? Um, this is data not from Carta. This is from Silicon Valley Bank across basically enterprise or B2B companies mostly. Um, and they looked at it for 2025, how much money at AR in terms of annual recurring revenue was in these companies at the time of fundraise. So the median for Series A was about 3 million bucks and the top quartile was 7. What this doesn't show, and what I think is even the more important point, is one, there are different business models. You're not expected to have $3 million of ARR if you are building a biotech company. And
Mhm.
two, and more importantly, the rate of growth is much more important than the absolute value. So if you are growing 10x week over week, you can probably raise a seed or a Series A at a much lower ARR than if you are growing 3x week over week. So these numbers are just points in time. But Monique, I know we were chatting before. Like this is
Yeah.
you always get asked how much money do I need? How do you generally respond to those?
Right. Um, so often, I mean, I got this question just yesterday in a meeting. Uh, a founder will ask, "What is the revenue that I need to have in order for you to give me a term sheet?"
Yep.
And unfortunately, there is no magic number at any stage.
Yep.
It's such a combination of factors that it's really difficult to say, yes, if you come back with 2 million in ARR, I can give you a term sheet. That just doesn't reflect the way that it works.
Yep.
Um, and so yeah, that's unfortunate, but um, I think right now a lot of investors are really, 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 I cannot stress this enough, focused on how quickly you get to revenue,
Yep.
because there are so many companies and so many deals that we are seeing where the revenue velocity is just extremely high.
Yep.
And if you are coming in with a lower revenue velocity, then that is a deal that can, to us, look like a less um, attractive deal.
Yep. Super well said. I mean, look, this is the thing that's on people's minds if we just want to talk about it. Cursor went from
Yeah.
$1 million in revenue to $1 billion in revenue in 2 years. That is unprecedented growth. In a world where cursors exist, right? Not all companies are Cursor, of course, but in a world where Cursor exists, what used to be great gets redefined because great has been pushed up. The very top of the market has been blown out. And so a lot of investors have had to recalibrate what great looks like for them and what they're actually looking
Mhm.
for. And even if they are not saying that you need to be a Cursor, and I promise you, the good investors know that not every company is Cursor, it still impacts their thinking. It
Yeah.
still changes the way that you go about your business because the world has changed. So of course you shift a little bit. All right. I know we wanted to save a good amount of time for questions here. I think we have about 10 minutes left. Um, this is really the question that I wanted to leave people on, which is when you're thinking about this fundraising journey and where you sit today in the capital stack and all these things, a more important question is what sort of company do you want to build? Venture is one path to building a great company, and it is the most vocal of paths, both from the founder side and from the VC side. Venture is good for many things, but it is great about talking about itself. Um, it is not the only way to build a business. And it is not maybe even the default way in many cases to build a business. So you got to look internally and say, what is my ambition? What is my co-founder's ambition? Because if you know very clearly the answer to this question, everything else becomes a lot easier.
Agree. I think, really getting granular about what your goals are and how those goals align with like your style of company building is really important to understanding whether you should take venture capital dollars or not. There are a lot of different ways to build a business. I would, I am confident in saying that today it is easier than ever to build something, and easier than ever to start generating revenue. And, in some ways that has made venture capital um, less important or less important to certain kinds of businesses. I do
Yeah,
still believe that venture capital is very important to building high value, high velocity businesses. And that's where we should be concentrating our capital. But if that's not the kind of business that you want to build, then, maybe you should evaluate whether venture capital is even necessary.
100%.
And
Thank you
I
so
have
much.
forever said that there needs to be more diverse types of capital available for company builders that is not only venture capital. Um, and I think that is a real failing of the innovation ecosystem that there aren't more different types of capital available.
Totally.
Truth. Um, but thank you guys, Peter, Monique, for walking us through the data.
Yeah, thank you.
As we wrap, just two quick notes. If this is your first time, I doubt it is because card data is everywhere. But if this is your first time sitting with funding data like this, it can feel overwhelming. To allay some of your anxieties, you do not need to memorize this data or even match it. Please don't do that. That's not the goal of
Yeah.
today's session. Um, this isn't about hitting the right valuation or the right deal size. The point of this session and the ones to follow is really to give you a better understanding of what today's market looks like at a high level so you can make smarter decisions based on your ambitions and your goals. So one, if that resonates with you, we are hosting an event, as I mentioned at the top of the call, Onward FX, happening on April 21st in Bentonville. There is an application deadline to be considered, so February 23rd. And we'll follow up with all of this after the talk. But if you are ready to raise, and if you are a venture scale company, we want to help you on that journey. Um, we are bringing 30 to 40 investors to the region later in April, but we also syndicate deals with folks like Monique and 200 other firms across the country. So if you're on that journey, reach out to us. apply. There are info sessions and many opportunities to plug in, including 3 more events that are happening this month. So our goal at the onset was to peel back the curtain and sort of show you inside the mind of the investors what they're thinking the first 10 minutes of that meeting, what they're looking at when they're doing diligence, and how they qualify if you are, in fact, venture scale. And yes, there are lots of different sub definitions and different fund strategies and different managers and people have. Um, they're pattern matching based on different things, but we hope uh, to to um, to make that journey less opaque. So thank you again to Peter and Monique. Q&A is still open, so if you do have questions and we're not able to get to them, feel free to send them to us, and we will try and answer them or get them answered to the best of our ability. And I just want to thank everyone again for jumping on today. And thank you to Michaela in the chat for dropping in the links. We'll send out an email. So you'll get the recording, Peter's deck, info on the events to come, and then the application. Deadline is February 23rd. Um, any final thoughts or CTAs?
Monique, go ahead.
Uh, no, I love coming to Bentonville, and fingers crossed that I'll be able to come again this year. But I would just encourage you all to build the best businesses that you can. If you're building something cool and unique, please reach out to me. My email is monique@cake.vc.
Um, I'm gonna instead of doing a CTA, there's one question in the chat that I wanted to get to because I think it actually is like good overall context setting, which is over recent years, VC has definitely been consolidating, but no one will talk about it. Can we address what's happening? I actually think everyone's talking about it.
Yeah.
Um, yes. So to your question, anonymous founder, yes, there will be materially fewer VC funds in 2 years than there are today. That
Yeah.
is 100% happening. The difference is A, that always happens. Just like founders, you can see founders going from seed to A, and there's always a drop off and all this kind of stuff.
Hmm.
Investors going from fund one to fund two to fund three, there's always a drop off. Something like
Yeah.
10% of investors, 10 to 15, will make it to fund four. So you think that being a founder is hard, and it is. Being a VC is not a cakewalk.
Yeah.
I was trying to make a cake ventures pun, but it didn't get up. So like this is not like an out of the normal thing.
Yeah.
Venture is a game of many interested, excited, curious people trying stuff and then most of the time failing. So to the Monique's point about building cool and unique businesses, like if we're being honest, a lot of these companies won't work. And that doesn't mean that the
Hmm.
time was wasted, and it doesn't mean that it wasn't worth the chance to try it on the investment side, on the founder side. Like it's exciting that you all are trying this in the first place. Um,
Hmm.
and you can find more data from us at carta.com/data.
And I will say that, when you think about VCs, we have to raise subsequent funds just the way that you have to raise new rounds. And every time we raise a fund, we are asking our investors to put us in business yet again. And not everyone is going to get to be in business again. And that drop off may happen at fund two, that drop off may happen at fund three or fund four. Um, I think that, in 2021, a lot of people who would not have otherwise, 2020 and 2021, a lot of people who would not have otherwise been in venture entered the venture space and started funds. And so you had a lot of like operator funds and a lot of these angel list funds and a lot of funds that um, were, they were serious people and not, I don't want to call them hobbyists, but, they were not necessarily meant to be around forever. And so I think you are seeing a lot of that attrition at first, but there will still be even more.
Yeah, well said.
So common thread here is keep fighting the good fight. Founders
Yeah.
and emerging managers alike, many of you are on this call. We
100%.
hope to see you and support you on your journeys. And if today's session was helpful, we hope you join us for the rest of the series. So thank you again, Peter, Monique. Super, super interesting insights, and thank you for the hot off the press data.
Anytime.
Thanks for having us. Thank
See
you.
y'all.
Bye,
Bye
everyone.
all.
Have a great day.